Hello, so it's May the 14th, 2020, and today I'm going to talk to you about Bitcoin, and in particular the halving or the halvening that took place a couple of days ago. Now, Bitcoin was born in reaction to the bailouts of 2008, and when the first digital coins were mined in January 2009, there was a headline quotation from the Times that was left embedded in what's known as the Genesis block. Those are the very first Bitcoins that were mined, and it said, "Chancellor on brink of second bailout for banks." And Bitcoin's creator, Satoshi Nakamoto, resented the iniquities of a fiat money system in which certain favoured bodies, governments and banks, have the ability to create money at no cost. Are you watching, Rishi Sunak? I doubt it. And one of the things that Satoshi said was escape the arbitrary inflation risk of centrally managed currencies. And with COVID-19 money printing at full throttle, the case for Bitcoin has got even stronger. But when Satoshi first designed Bitcoin, one of his key ideas was that money should have a cost of production to it. What's more, the supply of money should be finite. Unlike fiat money, which is pretty much infinite, the supply of money keeps on growing, Nakamoto wanted a system whereby nobody should have the power to create more of this money when it suits them. Money should have value because of its scarcity. And unlike fiat money, which is inherently inflationary, Satoshi wanted to create a deflationary system, the purchasing power of which increases over time. And Satoshi's plan was for a maximum of 21 million coins, but he couldn't create those 21 million coins all at once. It had to be gradual. So, how to create coins, how to disseminate them, and how to maintain the system. And Satoshi's ingenious solution to all of this was what he called mining. And just as gold and silver cost money to mine, so do bitcoins. However, you don't mine bitcoins with picks and shovels and drills, but with computers. You can set up a gold mining company if you like, and you could start drilling in your back garden if you wanted, but there is no guarantee that you'll find anything. There's a risk to it. And so with Bitcoin, you can set up some computers and start Bitcoin mining, but there is no guarantee you will get some coins out of it. But there is a chance you will strike gold, or there's a chance you'll successfully mine coins. And the better your gold or your bit mining operation, the more powerful your drills or your geological mapping or your computers, the better chance you'll strike gold or Bitcoin. And the potential reward is such that people take on the risk of mining. Now, every 10 minutes or so, a block of new Bitcoins is mined, and thousands of Bitcoin mining operations around the world, thousands of powerful computers compete with each other to mine a block and get the Bitcoin reward. And it's the combined power of all these computers that maintains the network. So the dynamic is that people are acting out of their own self-interest, which is the potential reward of coins or the potential reward of gold. But the result of that self-interest is that the system is maintained. It's quite sort of Ayn Randian. Now, early Bitcoins were easy to mine. There wasn't much competition. The network was small. But as Bitcoin evolved, so did the mining process grow more intense. And the more intense the mining process is, the more resilient Bitcoin becomes. It's a virtuous cycle. And so again, we see this digital replication of the gold mining process. Surface gold is easy to mine, but as the mine goes deeper underground, it gets more expensive and labour intensive and equipment intensive. And just as precious metals miners sell their produce soon after they mine it in order to fund future mining, that's their business model, so Bitcoin miners sell their coins soon after production, or most of them anyway. And thus do coins get disseminated. So what is this Bitcoin halving stuff all about? Satoshi coded a production or an inflation rate into the design. Coins have to get initially distributed somehow, he said, and a constant rate seems like the best formula. And initially, coins were produced at a rate of 300 per hour. And between Bitcoin's inception in 2009 and November 2012, a total of 10.5 million Bitcoins were created, half the eventual supply. But then the first scheduled halving took place, and the production rate fell from 300 to 150 per hour. 4 years later, in July 2016, we saw the second scheduled halving, and then there were almost 16 million coins now in circulation. The production rate fell from 150 to 75 per hour. And then on Monday, Tuesday, now with 18 million Bitcoins in circulation, we saw the third halving, and the production rate has come down from 75 to 39 per hour, so not quite a halving. And this process will continue every 4 years until sometime around 2140, when the 21 millionth Bitcoin is mined. Now, what does this mean for the value of Bitcoin? Now, in theory, if you reduce the inflation rate of money by half, the value of that money should rise. And the same applies to a commodity. Reduce the supply of that commodity by 50% and the price should go up. And the evidence of the two previous halvings is that bull markets of the change your life variety have followed. In November 2012, Bitcoin was trading below $10. 1 year later, it was north of $1,000. In July 2016, Bitcoin was around $500. 18 months later, it was at $20,000. So let's take a look at the chart. So this is a log chart of Bitcoin that goes all the way back to September 2011. Bitcoin was $2 back here. It's not even shown on the chart, but believe me, it was $2 back then. This is a log chart, by the way, so it shows the percentage gains. Otherwise, you look at Bitcoin charts and it just goes vertical like that and you can't study them. And here is the point of the first halving in November 2012, and Bitcoin was about $9 then. And you can see afterwards it went off on one heck of a bull market, ending at $1,200 here. And then we went into the first crypto winter. Bitcoin came all the way back to about $200. And here was the second halving, July 2016 at about 500. And that basically halved the inflation rate, and it set off another big launch in Bitcoin that ended January 2018 and 2017-2018 at $20,000, and then we've been in the sort of second crypto winter, and then here we are in May 2020 with the third Bitcoin halving. Are we going to get another one of these amazing runs? Let's hope so. But that story, the huge gains, has been baked into this halving for many months. But if you've been following me for any amount of time, if you've read my book, or you've read my column, or you've watched these videos, you should by now own some Bitcoin. In which case, my advice would be, enjoy the ride. If you don't own any Bitcoin, I cannot advocate enough, as I've said so many times, that you should. First, even at this price, first, familiarise yourself with the tech, and second, own some, even at today's price of $9,000, whatever it is. The potential of the thing is just too huge not to have a position. Only speculate with money you can afford to lose, all that stuff, but what is the potential? Now, I'm not one of these guys who argues that Bitcoin's going to replace the US dollar or anything like that, but I do suggest it has the potential to become the default cash system of the internet. And that gives, and I choose that word cash very carefully, and that gives it a scalability that fiat currencies, national currencies, don't have. A national currency is limited by its borders. There is no such limitation with Bitcoin. And so it can become an international currency of the internet. As I say, I'm not saying that Bitcoin will become the default system of the internet, and as a cash system of the internet. As I say, I choose the word cash very carefully. But there are all sorts of reasons why it could happen. There are just as many reasons why it won't. But wherever you stand on this divisive subject, you can't deny that the potential is there. And when something has that extraordinary potential, why would you not take a position? And of course, with all the money printing that's going on to bail out economies in the wake of COVID, the case for non-government money is all the stronger. But that is an argument for another day. Thank you very much for watching. Please subscribe to my channel, share this video with a friend, and I'll be back with another video probably sometime next week as soon as I can think of something to talk about. Until then, sayonara.